Okay, so you want to own an airline. Buy some planes, sell tickets, fly people around the world, and collect one of the most glamorous businesses money can buy. Sounds incredible. But here's the strange part. The global airline industry, across thousands of flights a day carrying billions of passengers a year, is expected to post a record profit in 2026 of around $41 billion. That sounds massive, until you realize it works out to a net margin of just 3.9%. On average, an airline keeps less than 4 cents of profit for every dollar a passenger spends on a ticket. And here's the part that should really give you pause. In May 2026, an airline that had been flying for 34 years, one of the largest budget carriers in America, shut down completely. Not scaled back, not restructured again. Ceased all flight operations, canceled every remaining ticket, and began liquidating its assets in bankruptcy court. This wasn't a startup that ran out of money in year 2. This was a company that had survived 3 decades in the industry, and it still couldn't find a way through. By the end of this video, you'll know exactly what it costs to start an airline, why the industry runs on some of the thinnest margins in all of business, why a 34-year-old carrier collapsed for good after 2 bankruptcies in under 2 years, and what it actually takes to make real money flying planes. What it actually costs to get off the ground. Airlines come in roughly 3 sizes, and the capital requirements escalate fast at every tier. The smallest entry point is a small regional or charter airline, a handful of aircraft serving limited routes. Realistic startup costs here run $10 million to $50 million, covering aircraft, insurance, and the initial regulatory approval process. The middle tier is a genuine low-cost carrier, the kind competing on national routes with 10 to 30 aircraft. Startup costs jump to $100 million to $300 million or more, and that's before you've sold a single ticket. The top tier is a full-service international carrier with dozens or hundreds of aircraft, global route networks, and long-haul wide-body capability, a business that isn't built from scratch anymore. It's built through decades of accumulated infrastructure, slot allocations at major airports, and fleet investment running into the billions. Here's the cost most people underestimate at every tier: the aircraft themselves. A single commercial jet can cost anywhere from $50 million to over $300 million, depending on size and range. This is exactly why more than half of the world's commercial fleet is leased rather than owned outright. Leasing dramatically lowers the upfront capital needed to launch, but it also means a huge share of your fixed costs are locked in through long-term lease agreements you can't easily walk away from if demand softens, a detail that becomes critically important later in this video. On top of the aircraft, you need an air operator certificate, the license that actually allows you to sell tickets and fly scheduled service, plus gate leases and landing slots that can cost airports millions of dollars a year, and enough trained pilots, cabin crew, and maintenance staff to run daily operations safely and reliably. Where the money actually goes, and why TE margin is so thin. Here's the number that defines this entire industry: the break-even load factor. Because so much of an airline's cost structure is fixed: the crew, the fuel to move the aircraft at all, the landing fees, the maintenance schedule. A flight costs roughly the same whether it's completely full or half empty. Industry benchmarks put the typical break-even point at around 70% of seats filled. Below that, you're losing money on the flight. Above it, every additional seat sold is close to pure profit, since most of your costs were already locked in the moment the plane took off. That dynamic explains why airlines obsess over load factor the way almost no other industry does. In 2025, the global industry hit a record average load factor of 84%, genuinely excellent by historical standards, and still only enough to produce that razor-thin 3.9% net margin forecast for 2026. Labor now represents the largest single cost component industry-wide at roughly 28% of total spending, ahead of fuel, as wage growth has outpaced productivity gains across the sector in recent years. Maintenance costs are climbing too, driven by aging fleets and ongoing supply chain disruptions that make aircraft parts harder and more expensive to source. Here's the part that breaks people's brains the same way a rigged casino game breaks a gambler's brain. You can run a genuinely well-managed airline, hit near-record load factors, keep costs disciplined, and still only clear a few cents of profit per dollar of revenue, because nearly every other cost in this business is fixed and largely outside your control. Fuel prices move with global oil markets. Labor costs move with a historically tight aviation job market. Lease rates move with interest rates and aircraft scarcity. The only lever you fully control is how full you can keep the plane, and even a record-setting industry-wide load factor barely produces a margin most other businesses on this channel would consider survivable, let alone attractive. Why a 34-year-old airline couldn't survive chances. You'd think that 3 decades of operating history would be enough experience to weather almost anything this industry could throw at you. One recent collapse shows exactly how wrong that assumption can be. Spirit Airlines, America's largest ultra-low-cost carrier, entered its first Chapter 11 bankruptcy in November 2024 after accumulating roughly $2.5 billion in losses since 2020. That first case moved fast, a pre-packaged restructuring that converted about $795 million of debt into equity and closed in just 114 days, with Spirit emerging in March 2025 under a new CEO who promised the company was finally on stable footing. It wasn't. By the second quarter of 2025, Spirit had lost nearly $257 million since exiting bankruptcy, despite having forecast a net profit of $252 million just months earlier. Two things collided at once. First, Spirit was dealing with a wave of Pratt & Whitney engine inspections that grounded dozens of its Airbus A320neo aircraft, cutting directly into the seat capacity it needed to hit its break-even load factor. Second, its aircraft lessor terminated a batch of leases, and its credit card payment processor began holding back cash reserves, draining Spirit's liquidity right as it needed it most. On August 29, 2025, less than 6 months after emerging from its first bankruptcy, Spirit filed for Chapter 11 again. The company spent months trying to engineer a second turnaround, filing a restructuring plan in March 2026 that aimed to cut its combined debt and lease obligations from $7.4 billion down to roughly $2 billion. But a spike in fuel prices and a failed attempt to secure government support collapsed that plan before it could close. On May 2, 2026, at around 3 a.m, Spirit ceased all flight operations entirely, ending 34 years in business and converting its bankruptcy case from a reorganization into a full liquidation. The lesson isn't that Spirit's leadership was incompetent, even though real strategic missteps clearly played a role over the years, including a blocked merger with JetBlue that might have offered a different path entirely. It's that this industry's fixed cost structure is so unforgiving that even a company with 34 years of brand recognition, a loyal cost-conscious customer base, and one successful debt restructuring already behind it, still couldn't survive a second wave of the same structural pressures: grounded aircraft, lease obligations, and thin margins, hitting all at once. How smaller carriers actually lose this money. 3 ordinary patterns explain most airline failures below the headline collapses. Pattern 1. Overexpansion into routes that can't sustain break-even load factor. Airlines chasing growth by adding routes faster than demand actually routinely find themselves flying half-empty planes on new routes while their fixed costs climb just as fast as their route map. Pattern 2. Excessive lease exposure without a cash cushion. Because leasing lowers the barrier to entry, it also means a carrier's fixed obligations can outlast a downturn in demand, exactly as it did for Spirit. A lessor with the contractual right to terminate or reclaim aircraft can strip a struggling airline of capacity at the worst possible moment. Pattern 3. Underestimating how fast fuel and labor costs can move independently of ticket revenue. Airlines that price routes based on current fuel costs, without stress testing against a genuine price spike, are one bad quarter of oil prices away from turning a break-even route into a money-losing one, with no ability to raise fares fast enough to catch up. What you actually walk away with. Scenario 1. A disciplined regional or low-cost carrier hitting the industry's better load factors, say 82 to 85%, with real cost control on labor and maintenance. At the industry average net margin of around 3.9%, an airline generating $500 million in annual revenue nets roughly $19 million in profit, a genuinely thin return relative to the billions in aircraft and infrastructure required to generate that revenue in the first place. Scenario 2. A well-run, larger carrier with strong brand loyalty, ancillary revenue from baggage fees and seat selection, and enough scale to negotiate favorable fuel hedges and lease terms. At $2 to $5 billion in annual revenue with a slightly better margin in the 5 to 8% range, real annual profit can reach $100 million to $400 million. Genuinely attractive at that scale, but still requiring years of disciplined execution with almost no room for the kind of compounding shocks that took down Spirit. So if you're chasing this business, remember the real rule of this industry. You're not really selling plane tickets. You're managing an extraordinarily thin margin balanced on top of fixed costs you barely control, where a single bad year of fuel prices, grounded aircraft, or lease disputes can undo decades of otherwise solid operating history. A lesson 34 years of flying couldn't ultimately save Spirit Airlines from learning the hard way.